Welcome back to the Deep Dive. Today, we are opening a file that I think might just contain the single most asymmetric trade setup in modern finance.
I think you're right.
If you've been watching the charts, and let's be honest, who hasn't been? You know the score. Gold just crossed a critical, a symbolic, and frankly, a deeply unsettling threshold. We are anchored firmly above $4,500 an ounce.
It's an astronomical number, and that's exactly where we have to pivot the whole perspective.
Okay.
Because we don't see that $4,500 price tag as a peak. Not a bubble, not a sign of success in the metals market.
Yeah.
We see it as the undeniable, glaring signal of a financial system failure.
Right.
Gold has successfully done its job. It's the world's ultimate crisis sensor. It has repriced for a new reality.
And what is that reality?
A reality saturated with historic, completely unsustainable debt levels, persistent geopolitical conflict, and structural inflation that, central banks seem utterly incapable of controlling. The system is screaming.
And when one part of the system screams that loudly, it throws everything else into sharp relief, doesn't it?
It does.
Gold is the canary in the coal mine. But the moment that canary screams at $4,500, it shines this massive spotlight on an historic dislocation in its sister metal.
That's it.
Silver. Currently trading around $75 an ounce is, mathematically speaking, it's still asleep at the wheel. It hasn't absorbed the signal yet.
It hasn't. And that's the key. So we're not here today to talk about hunches or sentiment or, predicting future crises.
No.
This deep dive is purely about the math. We are examining the gold to silver ratio, the GSR.
Right.
Which, it operates less like a fleeting stock price based on quarterly earnings and more like a fundamental law of financial physics.
A law of physics. I like that.
And when that ratio is stretched to its current level, it's pure potential energy. It must revert to the mean. It is the financial equivalent of a coiled spring pulled taut over millennia.
And if that mathematical law of reversion holds, the implication is stunning. And that's our core mission today, isn't it? To lay out the simple, unassailable arithmetic that points to silver being mathematically headed to a minimum of $300 an ounce.
$300. That's a fourfold return. And here's the key insight. That gain comes just by catching up to where gold already is.
So you're not even betting on a new crisis?
Not at all. You are simply betting on market efficiency and history. We're calling this the trade of a lifetime, but we have to set the tone immediately and clearly.
Yeah, this is crucial.
Silver is a wild horse. If you choose to ride it, you have to accept that the volatility will be extreme, and it will be a bumpy, likely terrifying ride for anyone who's unprepared for the sheer speed of the market correction.
Okay, so we've assembled all the necessary sources: geological reports, historical price data, deep analysis of industrial demand, and critically some pretty stark warnings from institutional traders to give you the full, unvarnished picture. We will first uncover the structural law of the ratio, explaining why the current gap is so unnatural compared to, 5,000 years of history.
At least.
We'll then execute the simple arithmetic for that $300 target. And crucially, we need to explain the psychology of why silver always lags so violently, and we must issue a strong, detailed warning about the systematic volatility, what the sources are calling the regulatory rigging, that you have to survive to capture these gains.
And finally, we'll wrap up with the often ignored practical reality of holding this kind of wealth. The sheer logistics of storing a fourfold increase in physical silver, it's not trivial.
So let's set the current scene. Gold has crossed 4,500. For the average, the late-to-the-game retail investor, this is the moment where that fear of missing out, FOMO, it just immediately converts into pure regret. They think, I missed it, it's too expensive now. They see 4,500 as the top, a sign of overheating. They're looking backward.
And that is precisely the psychological trap. The institutional capital, the Tier 1 reserve managers, the family offices, the really sophisticated rotation traders, what they see isn't a bubble in gold.
No.
They see a massive systemic mispricing in silver. Gold has done its job. It has fully repriced the systemic risk in the global financial architecture.
And silver hasn't.
Silver has not yet absorbed that signal. Gold is the anchor that proves the world has changed. Silver is the lagging asset that offers the leverage on that change.
Okay, so here's where we get into the nuts and bolts of the math that reveals this structural anomaly. We have to understand the gold to silver ratio, the GSR, in detail. So explain what that number actually represents and why it's so critical right now.
Okay, the GSR is it's simply the measure of how many ounces of silver it takes to buy 1 single ounce of gold.
Right, it's a relative value.
It's the ultimate relative valuation metric for the monetary metals. So right now, if gold is $4,500 and silver is $75, the math is simple. The ratio is 60 to 1.
60 to 1.
And if you look back through history, particularly during major financial or political upheavals, periods when fear was rampant, we have seen that ratio climb even higher.
Like what?
Sometimes it reaches extremes of 80 or even 90 to 1. But even at 60 to 1, the implication is stark. Silver at $75 is dirt cheap compared to $4,500 gold when you measure it against any structural or historical average.
That systemic disconnect, that's the core insight here. If gold and silver are both monetary metals used historically as safe havens, why is gold leading so violently right now and silver is just sort of sitting there at $75, offering this huge relative discount?
It all comes down to liquidity and the hierarchy of capital flight.
Yeah, hierarchy.
Yeah. Gold is the fear trade. It's the first, safest sanctuary capital seeks when the financial system shows true cracks. Think about it. Central banks buy it because it's a Tier 1 asset. It reduces counterparty risk. Sovereign wealth funds, major institutional treasuries, when they sense geopolitical danger, debt crises, or, runaway inflationary pressure, they buy gold.
It moves first.
It moves first because it is the deepest, most liquid market that acts as the global measure of confidence in fiat currency.
So gold absorbs the initial panic buying from the biggest players. Where does silver fit into that capital flight sequence?
Silver is the greed trade, or maybe a better way to put it is the catch-up trade.
The catch-up trade, I like that.
It just takes time for that initial massive block of fear-driven institutional capital to filter down. Once the market accepts that 4,500 is the new higher baseline for gold, that the financial crisis is real, and permanent investors start looking for relative value. They start looking for leverage.
And that's when the retail investor comes in.
That's a huge part of it. When the average family realizes they can't afford a $4,500 gold coin, they inevitably look at silver, which has always been called poor man's gold. This transition from institutional fear to retail recognition creates a massive rush of liquidity into a market that is, it's tiny by comparison.
And to give that comparison some teeth, we need to bring in some numbers to follow up on this fire hose analogy. This description from the sources, it perfectly illustrates the impending violence of the move.
The numbers are staggering, and they absolutely justify the analogy. Gold, globally, has an estimated market capitalization that sits north of, $14 trillion?
$14 trillion.
It is massive. It's capable of absorbing hundreds of billions of dollars in flow without immediate parabolic moves. The silver market, however, is dwarfed by this.
How small are we talking?
Depending on how you calculate it, the entire global silver market cap is maybe only $200 billion to $300 billion.
Wow.
That means the gold market is potentially 50 to 70 times larger than the silver market.
70 times. So when you bring the fire hose analogy back into it, we aren't just talking about a theoretical difference in size.
Precisely. Gold capital is the fire hose, a massive, high-pressure, high-volume flow of money.
Okay.
The silver market is the garden hose. It's a
Yeah.
fraction of the diameter, a tiny, tiny pipe.
Right.
So when that initial fear-driven capital, the high-pressure fire hose of money from institutions that have accepted the $4,500 gold anchor, when it tries to pour even a fraction of their assets into the tiny garden hose of the silver market, the pressure doesn't just build gently.
No.
The sources describe it perfectly. The pipe bulges dramatically, and then it explodes. We are currently in that bulge phase.
So the pressure is building right now.
The initial move in gold has happened, signaling the system is broken, and now institutional money and sophisticated rotation traders are identifying the only cheap asset left on the block silver. The math dictates that money must flow there to normalize the ratio. It is a structural inevitability.
That initial setup frames the opportunity beautifully. But now we move past the current anomaly, and we have to talk structural law. We need to defend the thesis that this isn't just a temporary trade. Why is the current ratio 60 to 1 so unnatural that we can be confident it must snap back to 15 to 1? This requires looking at, thousands of years of history and geology.
Right. We must define the structural law of the ratio based on 3 fundamental pillars: geology, history, and current demand. Starting with nature itself, the first definition is the geological ratio. This is non-negotiable science.
Okay.
For every single ounce of gold that is dug up from the Earth's crust, we find roughly 8 to 10 ounces of silver.
8 to 10.
So nature itself set the price expectation. The Earth's crust dictates that silver should be about 1/8 or 1/10 the price of gold, simply based on relative scarcity underground.
That's the deepest foundation you could possibly have for an asset's value. But if geology dictates 8 to 1 or 10 to 1, why did human civilizations, like the Romans, settle on 12 to 1, or the Americans settle on 15 to 1? What variables caused that deviation from the start?
That's where politics and human preference come in. It's a great question. You see, silver is more complex. It tarnishes. It has more industrial uses, making it less pure as a monetary store over very long periods compared to gold.
Gold is just inert.
Gold is chemically inert. It's beautiful. It doesn't corrode, making it the perfect long-term reserve. So historically, governments decided that a slight premium was due to gold for its superior monetary qualities. If you look at historical fixed prices, governments tried to codify this blend of geology and monetary preference.
Give us some examples of that codification.
Certainly. In the Roman Empire, the ratio was stable around 12 to 1 for centuries.
Wow, for centuries.
For centuries. Fast forward to the early American Republic. The U.S. Coinage Act of 1792 fixed the ratio at 15 to 1 for bimetallism.
15 to 1.
And this 15 to 1 ratio became the established, centuries-long mean, the gravitational center of the precious metals universe. When we talk about reversion to the mean, this 15 to 1 ratio is the traditional target that suggests the most dramatic leverage.
Wait a second. If the ratio has hit extremes of 80 or 90 to 1 in the past, why are we so certain that 15 to 1 is the target? Couldn't it just revert to, say, 40 to 1 and stay there, cutting our $300 target in half? The financial markets don't always respect ancient history.
That is a crucial challenge, and the answer is rooted in the metaphor of the coiled spring. When the ratio hits 80 to 1 or 90 to 1, that represents maximum tension. It is pure market panic or distortion pushing it away from the structural norms. We have seen periods of temporary reversion to 40 to 1 or 35 to 1, sure, but the violent snapbacks, the generational trades, they happen when the ratio seeks to reestablish a much lower, historically validated equilibrium. Every single time the markets push the ratio this high, the institutional capital recognizes it as immense potential energy that must snap back.
So the smart money is basically betting on the structural anomaly correcting itself.
Yeah.
What does history teach us about the violence of that snapback?
History gives us some really compelling proof points. We saw it violently in 1980.
Okay.
Fueled by runaway inflation and, of course, the famous attempt by the Hunt brothers to corner the market, the price exploded and the ratio snapped back from around 40 to 1 down to an astonishing 17 to 1.
17.
And that happened in a matter of months. More recently, in 2011, during the fear of early quantitative easing and the peak of the commodities boom, the ratio snapped back sharply from around 80 to 1 down to 30 to 1.
Okay, so 30 is the more modern precedent.
It is. The sophisticated investor knows that the price of silver is temporary, but the structural ratio is the law that must eventually be followed. They are buying the stretched rubber band, knowing the kinetic energy stored within it is just immense.
Now let's introduce the dual thesis. This is the fundamental reason why the snapback might be even stronger and more violent now than it was in 1980 or 2011. This connects the GSR mechanics to silver's dual nature. It's no longer just a monetary metal.
This is the revolutionary part of the current cycle. In 1980, silver was overwhelmingly a monetary asset. Today, it is a strategic industrial metal that happens to also hold monetary status.
Okay.
Silver now has a robust price industrial floor due to immense structural demand that simply did not exist during prior rallies.
Yeah.
We're talking about the technological backbone of the 21st century.
Like what specifically?
Electric vehicles, massive server farms supporting AI, and most importantly, solar energy.
That industrial demand means that even if a global recession temporarily hurts monetary demand for a bit, the industrial usage acts as a floor, right? It prevents the kind of crash we saw 40 years ago.
Exactly. The supply-demand dynamics are irreversibly changed, and the industrial demand isn't just persistent, it's accelerating exponentially. This brings us to what the sources are calling the solar black hole.
The solar black hole.
But we have to dive into the technical details here because it's fascinating. The global push for clean energy, driven by governmental mandates and massive infrastructure spending, means solar panel production is skyrocketing.
I understand solar uses silver, but why is this creating a black hole structural deficit?
Because of the drive for efficiency. The new generation of high-efficiency solar panels, specifically the N-type technologies like TOPCon and HJT, they require more silver per cell than the older P-type panels.
How much more?
We are seeing increases in silver loading of up to 50% per panel.
50%, wow.
Because silver is the most conductive metal on Earth, and conductivity is paramount for maximizing energy output. Furthermore, the sheer scale is overwhelming the supply chain. Global solar capacity is projected to grow by hundreds of gigawatts annually over the next decade.
So volume is up and usage per unit is up. But why can't we just recycle it? It seems like an obvious solution.
This is the critical, often overlooked detail. Once that silver paste, which is only a few microns thick, is applied to the silicon wafer and encased in a massive glass panel, it's practically gone for 2 decades.
Gone.
I mean, recycling solar panels is chemically complex, it's energy intensive, and it yields a frustratingly low recovery rate for the silver because it's so dispersed across large surface areas. It is currently cheaper and easier to mine a fresh ounce than to recover the small amount locked away on a rooftop.
So we're taking a precious strategic monetary metal and essentially burying it on rooftops and in solar farms globally for 20 years.
Creating a structural, unresolvable supply deficit that mining simply cannot keep up with.
That structural reality fundamentally changes the game. Mining supply takes a decade to come online, if permitting even allows it. So if we're eating silver faster than we can dig it up, the industrial pressure makes the monetary snapback not just likely, but structurally supported. The spring is coiled, and the market is shrinking at the same time. That historical and geological foundation is solid. We have the $4,500 gold anchor, and we have this structural pressure from the industrial floor. Now, let's transition from that macro analysis to the simple, cold arithmetic that drives this catch-up trade and gets us to $300.
Okay. We're going to walk through the price roadmap in detail, and let's assume gold stays precisely where it is, $4,500. Like, we're anchoring this thesis there to prove the point. Silver doesn't need gold to go higher for this trade to work. It just needs the ratio to normalize.
Okay, let's start with the conservative scenario, the one based on recent memory.
Scenario A, conservative reversion. We look back at the 2011 high water mark. At that time, the ratio managed to revert down to 30-1. At that level, silver demonstrated it could trade at parity with its short-term historical monetary past. The math is simple. If gold remains at 4,500, divided by a 30-1 ratio, silver hits $150 an ounce.
150.
That is a 100% return from current prices just by hitting a precedent we have seen in our lifetimes. This is what you might consider the minimum high probability target.
And $150 is a compelling enough target for most investors. But the real leverage, the generational opportunity, that lies in the full historical mean reversion.
Scenario B, historical mean reversion. This is the destination based on 5 millennia of human economics and geological reality. If the ratio reverts to the centuries-long, geologically sensible 15-1 ratio...
The one codified by the U.S. Coinage Act.
Exactly. The calculation is even simpler. $4,500 for gold divided by 15 equals $300 an ounce for silver.
$300.
That's a stunning fourfold return solely based on the mathematical correction of a broken financial relationship using the current price of gold as the yardstick.
When you lay out the arithmetic that clearly, it just shifts the entire perspective. The focus isn't on predicting silver's price, it's on predicting the ratio.
Absolutely. But we have to also discuss the high-end possibility, because sophisticated investors don't assume the anchor point of 4,500 for gold will hold static.
Right, that's just our baseline.
It's our baseline. We have major global financial institutions, names like Bank of America, JP Morgan, Citi making much higher projections for gold based on the current debt trajectory, and continued monetization of fiscal deficits.
What are those high-end projections saying?
They're projecting gold to hit $5,000, $5,500, some even say $6,000 by 2026, assuming the current monetary environment persists.
Okay, so let's run that number.
If we take that $6,000 projection as our new anchor and the ratio reverts to 15-1, silver goes to $400 an ounce.
$400.
This illustrates the massive intrinsic leverage inherent in the ratio trade. Silver is structurally designed to outperform gold in a monetary snapback.
And this leads us to the critical concept, the asymmetry of the trade. Why is this a structurally superior bet compared to just holding more of the gold anchor?
Because of the relative effort required for the gains, gold has to work incredibly hard to double from 4,500 to 9,000. That would require a total undeniable loss of confidence in the US dollar, perhaps driven by the complete collapse of the bond market, a crisis far exceeding anything we currently see.
It requires a new catastrophic black swan event.
It does.
And silver.
Silver, however, can achieve a fourfold gain from 75 to 300 just by catching up to where gold already sits. It doesn't need a new crisis. It just requires market forces to recognize and correct the massive structural anomaly created by the initial lag.
It just requires arbitrage.
It's a bet on financial physics reasserting themselves, not on predicting the future collapse of society. That asymmetry is the core appeal for institutional rotation capital.
Now, we absolutely have to transition from the mathematics of profit to the psychology of survival.
This is the hard part.
It is. Because if this were a straightforward trade, silver would already be $300.
Yeah.
Silver is notoriously difficult to hold, and it has earned its nickname, the Widowmaker. Despite the massive upside we just laid out, this trade is a high-risk, high-volatility proposition specifically designed to shake out the impatient or leveraged investor.
This is the most crucial segment for preparation. People need to understand the psychological devastation this metal can inflict.
So give us the historical pain points, the lessons of 1980 and 2011.
The parabolic moves in silver history come with violent, capital-killing crashes. Take 1980. Silver started 1979 around $6 an ounce.
$6.
Due to massive inflation, geopolitical turmoil, and the highly publicized attempt by the Hunt brothers to corner the market, silver went to an astonishing $49.45 by January 1980. But then the floor dropped out. By March 1980, just 2 months later, it had crashed back below $15, and within a few years, it was below $10. Most who bought near the top were financially ruined.
In 2011, I imagine it was a similar story.
The 2011 cycle, fueled by quantitative easing and money printing, was less extreme but equally violent. Silver rallied aggressively, hitting $50 an ounce again. Retail investors piled in, convinced they were witnessing the final structural break.
Right.
Then, in the second half of 2011, it began a long, protracted slide that took it all the way back down to $13 within a few years.
Wow.
An investor who bought at $50 had to endure a loss of 75% of their capital just to prove the long-term thesis correct. The speed and depth of these corrections are designed to inflict maximum emotional and financial damage.
What drives those violent market-killing crashes? Is it just simple profit-taking, or is there a systematic mechanism at play that targets leveraged money?
It is entirely systematic, and it's what we call regulatory rigging or the margin manipulation game. The sources are crystal clear on this. The game is rigged against high leverage.
How so?
When silver goes parabolic, when the price begins to genuinely squeeze the supply, the exchanges and regulators step in to protect the short sellers, who are typically the large bullion banks and institutional players.
So how do they do that? Detail the mechanics of how they move the goalposts mid-game.
They do it by rapidly and dramatically raising margin requirements on futures contracts. Let's say you bought a contract requiring $10,000 in collateral or margin.
Okay.
If the price surges, say from $75 to $95, the exchange might suddenly announce that the margin required for that exact same contract is now $20,000 or even $30,000 overnight.
So the investor, even though they're sitting on a paper profit, suddenly needs to produce tens of thousands of dollars in new cash collateral immediately.
And this forces leveraged investors, who might be totally correct on the $300 long-term thesis, to liquidate their long positions because they simply cannot afford the increased collateral.
And that forced liquidation is what causes the crash.
That mass, forced liquidation, floods the market with sell orders, causes the panic crash, wimps out the retail leverage, and conveniently protects the massive institutional short positions that were underwater.
This is an actionable warning then. If you use leverage futures or options in the silver market, you will likely be wiped out, even if your $300 thesis is fundamentally correct, because the exchanges will simply raise the margin requirements until your collateral is exhausted.
You must hold the position in a way they cannot liquidate. Physical metal or fully paid unleveraged shares in a trust that actually holds the metal. This is a position built on patience, not speed, purchased with cash you do not need for the next 5 years.
Let's discuss the psychological barrier of $100. That's the point where this trade transitions from an investment thesis to a market mania, and where the supply chain breaks down.
The sources indicate that $100 for silver is the point of no return for the retail world. That's when it makes the evening news headlines and the mass retail FOMO arrives.
And the supply chain can't handle it.
Not even close. The supply chain for physical silver, the minting and refining, is already paper thin due to decades of industrial consumption draining the available vaults. When the global public tries to enter a market this small and illiquid, premiums explode.
We saw evidence of this disconnect even in small temporary rallies, didn't we?
Absolutely. The 2021 Reddit-fueled rally provided a perfect microexample. The COMEX spot price might have been $25, but you literally could not buy a physical Silver Eagle coin from a dealer for less than $40.
That $15 premium.
That $15 premium was a warning signal that the paper price and the physical reality were already disconnecting. At $300 silver, the paper price might be $300, but the physical price on the street might be $400 or $500 an ounce because the metal simply isn't available for immediate delivery.
So the risk shifts fundamentally from worrying about price volatility to worrying about availability. The window for buying cheaply closes rapidly once the panic hits 100.
It slams shut.
This brings us to perhaps the most insidious risk, the paper versus physical trap. Many people choose the convenience of popular exchange-traded funds, ETFs, and might be setting themselves up for disaster just as the metal makes its parabolic move. We need to clearly contrast the structures.
This is a critical distinction that determines whether you capture the squeeze or miss it entirely. Many widely known ETFs, like SLV, are structured using something called unallocated metal, or paper contracts.
What does that mean, unallocated?
It means the fund has flexibility in how it sources the metal and, crucially, flexibility in how it pays you during a crisis.
And this is where the force majeure clause hides, right?
Correct. Hidden deep in the fine print of many standard paper ETFs is a force majeure clause. This means that if there is a true systemic physical shortage, if industrial buyers drain the vaults and mints can't produce coinage fast enough, the ETF can invoke that clause and settle your shares in cash, not metal.
So let me get this straight. Imagine silver is rocketing toward $300, and the ETF declares a shortage.
They can close your position at the last easily obtainable cash price, say $100, and you receive dollars. You miss the entire violent squeeze because you were holding a paper promise that failed in the exact moment you needed it most.
Wow. So the smart money insists on specific, verified trusts that minimize counterparty risk. Detail the difference with a trust like PSLV.
The alternative preferred by institutional rotation capital is to use trusts like the Sprott Physical Silver Trust, PSLV. PSLV is generally structured as a closed-end trust. It holds fully allocated metal, meaning every share represents specific, identifiable ounces.
And you can get the metal.
More importantly, it is structured to allow for large-scale physical redemption. While it's difficult for a small investor to redeem, the mechanism is there, which forces the fund to maintain physical inventory. They know that when the paper price and the street price disconnect, when reality takes over the derivatives market, you must be holding the hard asset. You own the asset, not a promise of cash settlement. That is the non-negotiable insurance policy against regulatory rigging.
Okay, we've anchored the signal at $4,500 gold, we've defined the $300 destination through mathematics, and we've issued a dire necessary warning about the volatility and the structural traps. Now let's synthesize this into the structural trade and discuss how to navigate this choppy environment for maximum return.
The goal here for the truly sophisticated investor is not measured in paper dollars. It's measured in core wealth accumulation. This is the ratio trade, multiplying ounces for free.
For free.
The primary goal of institutional capital in this sector is always to compound their core wealth, their ounces of gold, which is the ultimate Tier 1 reserve asset, by rotating through the volatility of silver.
Walk us through the steps of this rotation strategy, because this reframes the entire purpose of the trade.
Okay. It is a patient three-step cycle that plays the structural anomaly from maximum tension to maximum correction.
Step 1.
Step 1 today. The rotation in. The ratio is currently high, say 60-1. Gold is relatively expensive. Silver is relatively cheap. You execute the rotation. You trade 1 ounce of your overvalued gold for 60 ounces of undervalued silver. The goal is to maximize the number of silver ounces you can acquire per gold ounce.
Okay, that's straightforward.
Step 2. Wait, The endurance phase. This is the hard part. You must endure the volatility, the whipsaws, the regulatory rigging, the 50% crashes, maintaining the absolute confidence that the structural law of reversion, geology, and history will hold, and industrial demand will continue to tighten the supply.
This could take years.
It could. It requires extreme emotional discipline.
And step 3.
Step 3, exit. The rotation out. You wait until the ratio snaps back to its historical mean, say 15 to 1. At this point, silver is relatively expensive and gold is relatively cheap. This is the moment to reverse the leverage. You trade those 60 ounces of silver back. At a 15 to 1 ratio, 60 ounces of silver buys you exactly 4 ounces of gold.
So you started the cycle with 1 ounce of gold, and you successfully ended the cycle with 4 ounces of gold. You quadrupled your ultimate non-fiat Tier 1 asset holdings.
Exactly. You leveraged the structural inefficiency of the market to compound your core wealth without putting in a single extra dollar. You simply played the cycle of structural law. This is the definition of multi-generational wealth building. Sophisticated investors don't just hold metal. They rotate between the cheap and the expensive metal based solely on the ratio. They ignore the dollar price noise.
That distinction is paramount. The objective isn't just to sell when the price hits 300. The objective is to increase your gold holdings by using silver as the mathematical lever.
Precisely.
Yeah.
Now, for the listener who wants a disciplined playbook to execute this long hold, what should they be monitoring besides the dizzying spot price?
Okay, first, patience and emotional discipline. You must ignore the noise. We detailed the violence of the 1980 and 2011 moves. Silver will crash 10, 20, even 50% on the way to tripling. It's a wild horse designed to buck you off. If you are stressed by daily price swings or if you will need this capital in the short term, this is not your trade.
Absolutely not.
Second, let's reiterate the leverage warning. Buy only with cash you don't need for 5 years. Do not use margin, derivatives, or paper instruments vulnerable to force majeure clauses. Insist on physical metal or validated trusts like PSLV.
And critically, the exit signal. You shouldn't be watching the dollar price for your exit. The paper price can be deceiving, manipulated, or hyped by the media too early. Your exit signal is the ratio itself. The time to rotate those 60 ounces of silver back into gold is when the GSR hits 20, signaling the end of the high leverage phase, or ideally the historical mean of 15.
Once the ratio is corrected, the leverage of the trade is gone. You've maximized your ounces of gold, and that's the time to rotate that newly acquired quadrupled gold holding into the next undervalued anti-bubble asset class, whether that's land, energy, or perhaps some other asset that is yet to absorb the system failure signal.
The ultimate confidence in this trade means holding when the ratio is 60 or 80 and executing the sale without hesitation when the ratio hits 15. It requires trusting history and mathematics more than your own emotions.
Okay. To reiterate the central thesis then, $4,500 gold is the undeniable signal of a financial system under deep structural stress.
It's the fire alarm.
Right. And $300 silver is not a speculation. It is the mathematical, historical destination of the structural correction, supported by both geology and accelerating industrial demand.
The gap is wide, the snapback is inevitable, but you must, without exception, expect stomach-turning volatility along the way. Be prepared, be disciplined, and understand the rigging.
Now, let's wrap this up with a final provocative thought, something that I think virtually every investor completely overlooks when they successfully execute this trade.
Yeah.
The sheer physical reality of wealth storage.
Yes.
We've been talking in abstract terms about ounces and dollars, but let's bring it down to the basement, or perhaps the secure vault.
This is a critical point that differentiates commodity wealth from digital wealth. If your thesis succeeds, you have a physical possession problem.
Exactly. Let's revisit the success of the ratio trade. If you began with 1 ounce of gold, $4,500, and successfully quadrupled your wealth, you end up holding 4 ounces of gold.
Right.
Gold is incredibly dense. 4 ounces fits easily in a small pouch, maybe the size of a matchbox, easily storable in a safe deposit box or small home safe. Storage is logistically simple.
But silver is a different beast entirely. It is bulky, and it takes up immense space relative to its monetary value.
If you bought 60 ounces of physical silver today at $75 an ounce, you're holding roughly $4,500 worth of metal. That's already a decent chunk of weight.
Yep.
If silver hits $300 an ounce, your successful fourfold return, you are now sitting on $18,000 worth of silver. But because silver is significantly less dense than gold, and because you needed 60 ounces of silver compared to just 1 ounce of gold to initiate the trade, the physical volume and weight of the silver required to hold substantial wealth are immense.
So much more. For every ounce of gold, you need a substantial handful of silver ounces.
Let's scale that up. If a serious investor initiates this trade with, say, $450,000 worth of gold, that's 100 ounces, and rotates that into 6,000 ounces of silver, and silver then hits 300, they're sitting on $1.8 million in physical wealth.
That's life-changing money.
And 6,000 ounces of silver is not a pouch. We are talking about several dozen large, heavy, highly visible boxes, potentially weighing hundreds of pounds. The sheer volume makes traditional home safes impractical, and you begin dealing with commercial vaults or specialized insured storage.
So here's a question for you, the listener, to mull over long after this deep dive is done as you formulate your entry strategy.
If this trade succeeds, and you realize a multi-million-dollar gain, not in a digital account, but in thousands of ounces of physical metal that is heavy, bulky, and takes up significant volume, where do you physically store that much weight and volume securely outside the banking system?
The logistics of physical wealth protection become the next most critical problem you must solve immediately upon the structural correction. Think about that as the spring tightens.